thank you for everyone for coming. We're going to just wait a little while for people to filter in, and then we'll get cracking on the prezzo. So what are we talking about today,
We're going to be
Azaria?
talking about life insurance for young families. So we've done one webinar in the past, and this one's going to be specifically for people with young families or looking to start a family themselves, and all the things that you should consider when it comes to insurance. So very relevant for a lot of our client base. We have a lot of young families, so we've got lots to talk about, and plenty of questions to answer as well, which will be good.
The good thing about insurance is most people are in the same situation. So they're earning an income, got debt, whether they've got financial dependence yet or planning on it or not. Insurance is actually kind of relevant to a lot of people. So it's good. So even if you don't have a young family or not yet or never plan to, then insurance is still pretty relevant to us all. So I think I'll share the screen and we'll get started. So one thing, everyone playing at home, so we've got a Q&A. We're going to do a Q&A at the end. So we're here to answer as many questions as you have. So last webinar we had, over 100 questions. We weren't able to get to them all. We've allocated more time in this webinar to get to those questions. We are probably not going to take the full 2 hours that it said on the thing. I hope not, and I'm sure you hope not as well. We're going to talk about young families and life insurance. What do you need to know? So myself, I am Phil Thompson, one of the financial advisors at Skye Wealth, and today we have Azaria Bell, who is also an advisor.
That's correct. Yes.
At Skye Wealth. So everything we talk about today is all general information. Please don't come back and sue us and say, Phil told me to do this or Azaria told me to do this, because we're not telling you to do anything. Go seek personal financial advice before you act on anything. Please don't blame me for anything. So the importance of life insurance for young families. Now, why is it important? Now, nearly 80% of Australians say they insure their cars, but only 23% say they insure their life, which is insane to think that, you're your most important asset, especially if you've got a young family, like they're relying on you for care or for income. It's not just you that's relying on you now. You got little ones. So I've got 3 little ones, 3 daughters. 11, I should know their ages off by heart, 11, 9 and 8, and they are all very heavily reliant on Kate and myself being around for a really long time. And if we unfortunately weren't able to be around, money isn't going to bring us back to life, but it's going to ease a lot of financial burden. So just like crashing your car, if you didn't have insurance, you kind of freak out. How am I going to buy a new car? Do I buy a bomb? How do I get through life? It's the same with life insurance. Even though it's less likely to happen than a car accident, it's so much more financially impactful than having a car accident. So it's just as important, if not more important, than getting car insurance. It's good. So 23% have life insurance, and it's increased. So we've got a few more percentage actually getting life insurance with young families, but only 29%. So still, families with children, the need for life insurance is there. It's really important. So today, what we're going to do, we're going to talk about kind of the nuances of insurances, like things to think about. So that's the purpose of today. So hopefully you walk away with a lot more understanding of, if you've got insurance, is it enough? Do we need to increase it? Or at least just a better understanding of your insurance kind of needs and what you require. So what we're going to cover is the types of cover, like what are the different policies? It's not just life insurance that we're talking about. So we're going to be looking at things like life insurance, disability insurance, income protection, trauma cover. Like what the heck does all that mean? How does it work? And so Azaria is going to run through those different types of covers. I'm going to be talking about some common misconceptions. So, as financial advisors, we hear so many things about insurance, whether it's true or not true. And we're just going to talk about some of the kind of misconceptions people have about, how affordable is it? Is it necessary? So we're going to touch on that, as well as some case studies. So the unfortunate truth is that people do claim on these policies. And so we're just going to touch on some of our client experiences that we've had. And then we'll talk about determining the right cover for your family needs. And then we'll go into Q&A. So please do ask heaps of questions. If you've got any questions, we'll try and address as many of them as possible. And yeah, let's get started talking about the different types of cover.
Perfect.
Azaria.
Alrighty. So we're going to chat about 4 different types of cover today. There's 4 main things that we look at. The first one is life insurance, also known as death insurance. We're also going to look at total and permanent disability cover, as well as income protection and trauma. So a lot of people will have life and TPD, also known as total and permanent disability cover, through their super, maybe some income protection as well. So we're going to have a bit of a deeper look at those and also touch on trauma insurance, which is unfortunately one that people often overlook, but it is very important. So starting out with life cover. What life insurance does is it essentially pays a lump sum of money out to your beneficiaries if you were to pass away or if you were to be diagnosed as terminally ill. So some of the things we're looking at when we're looking at life insurance is, number 1, replacing your income after you pass away. So for example, if you were to pass away, you may have plans to send your kids to private school. You may have a lot of future plans that you have been working on, which would no longer be possible with that loss of your partner's income. So we're wanting to make sure that at least 10 years worth of your income is being covered in the event of your death. What we also want to do is have the opportunity to completely clear the mortgage. So we don't want to have one partner left trying to clear an entire mortgage that was meant for 2 people on 1 income. So we'd like to have the ability to be debt-free in the event of something like that happening. And the other thing that we also want to cover as well is funeral costs. So there's a number of things that come under life insurance. How much you need is completely dependent on your situation, your debt levels, your responsibilities financially. But that's essentially what life insurance is. So that one's very straightforward. If you're dead, as Phil often says. And that's how the life insurance works. Then the next one we've got is total and permanent disability cover. So you may hear this referred to as TPD for short. And this would pay out a lump sum if you were to be deemed totally and permanently disabled and unable to ever work again. So of course, that's a pretty severe thing to have happen. It can't really get much worse than that financially. So you want to make sure that if it did, you have sufficient funds there to help you cover the expenses associated with that. So there's a few different things that we're looking at when we're looking at TPD. We're wanting to replace your income over the long term. So income protection does do most of the heavy lifting for that, but we want TPD to make sure that any shortfalls are also covered. Again, we want to have the opportunity to clear the mortgage entirely in the event that one person is totally and permanently disabled, potentially requires care at home, and that could potentially mean that both partners, then we want to have the ability to completely clear the mortgage. And we also want to be able to cover any medical permanent disability diagnosis. So if you were to, example, need rehabilitation, if you would need to cover medication, or even if you'd need to cover the cost of things that cover. Did that just cut out, Phil?
Yes, you did for me. I'm trying to work out if it was me or you. You cut out a little bit.
No, I got it. Okay, cool. What did you last hear?
You're talking about medical costs. So TPD covering medical costs and like rehabilitation and things like that.
Yeah. So it's really impossible to know exactly what your situation will be in the event of permanent disablement. So we just want to make sure that you've got a cash buffer there to help you if that were to happen. So that's the life and the TPD. So life if you pass away, TPD if you're permanently and totally disabled. Then the next one we've got is income protection. So a lot of people might have this through their super fund. And what income protection essentially does is covers a portion of your income if you were off work for an extended period of time due to either illness or injury. So in the event that you couldn't work, we want income protection to kick in and be able to cover your living expenses throughout that time. So income protection will generally pay you as a percentage of your income until you're able to go back to work or until age 65 if you've got an income protection policy that can go for that long. So we really want to make sure that you are still able to maintain a similar standard of living if you were unable to work for a period of time. And then the last one we've got is trauma insurance. So not as many people know about this cover, but it is one of the most claimed on policies. As you're going to see in this presentation, a lot of our examples relate to trauma insurance. And the way to think of trauma cover is essentially serious illness cover. So there's about 40 different things that trauma covers. And upon diagnosis of one of those 40 conditions, trauma would pay a lump sum of money into your bank account. Now, the top 3 reasons we see people claiming on trauma is number 1, for cancer diagnosis, number 2, for a heart attack, and number 3, for a stroke. So in the event of those things happening, you'd get a payout, and you can use that for a number of things. Some of the things that we often look at is number 1, covering any out-of-pocket medical costs. So you may have, of course, Medicare, you might even have private health cover, but this can cover anything above and beyond that. So if that's needing medication that's not under Medicare or needing to go overseas to receive treatment, for example, we want to make sure that you've got the cash available to do that. We also want to cover any short-term loss of income. So your income protection will generally have a waiting period. So it may be that we want to cover some of that waiting period with your trauma payout. Trauma pays out quite quickly. It could also be the case that, for example, if one member of the family was diagnosed with cancer and was unable to work in that time, they may need more care around the house or more care at home for the children. So it could be that the other partner, the healthy partner, also needs to take some time off work. So their income protection wouldn't kick in at that point. So you want to make sure that trauma is covering all of your bases so that you can afford to take some time out to care for each other. And then additional care for children as well. So if you needed to be attending doctor's appointments and you weren't able to be at home as consistently, then again, you've got some cash there available to help you through that. So any number of things trauma insurance can cover, but we do find that income protection and trauma are 2 of the most claimed on policies. So that's a bit of a summary of the 4 different types of cover. Now, there's 3 different types of insurance in general when we're talking about personal insurance. There's number 1, group cover. So if you've got any insurance through your super fund, you might have some group cover in there. Often it's default cover that's just given to you when you open the fund, and it can be quite cheap when you've got small amounts. And then when you start to increase those amounts, they can become a bit more expensive. You've also got direct cover. So if you were to go directly through an insurance company, or if you were to see the ads on TV for direct insurance, that's kind of what you're looking at there. And what we really value and specialize in is retail cover. So you need to go through a financial advisor to access these policies. They're very comprehensive. They're guaranteed renewable, which means once you've taken out the policy, the insurer can't change the policy on you in terms of making it worse. They also can't cancel the policy on you. And it's usually, it is completely underwritten. So you'll know exactly what you can and can't claim for. There's no surprises at claim time, going to lodge a claim and then that being declined due to something that's happened in the past. You'll know 100% from the start what you can and can't claim on. So that's really what we look at. We also consider the other insurances as well. If you've already got some of that, there's a few different things, and I'm sure Phil will touch on how we determine how much cover we think you need and why. But that's just a bit of a summary of the different types of cover. Next thing we've got is for Phil to talk about some of the misconceptions. So a lot of you might have heard about these policies. Maybe you've heard some misconceptions out there. So Phil is going to go ahead and debunk some of those.
Yeah, so I'll touch on a few. I mean, there's heaps. Unfortunately, there's no end to kind of the fake news. Is that what they call it these days? So I'm going to touch on a few, but there's heaps that we can talk about. I actually spoke to a client a client's wife who was claiming, who's actually in the case study, and she was worried about claiming on the cover, the trauma cover, because she didn't want it to impact the life insurance. And the reason why she thought that is because her friend, who's got nothing to do with insurance, told her not to do it. And so it was basically $190,000 that they could have accepted, which they ended up doing. They ended up getting the claim. But there's many misconceptions. I'm just going to touch on a few key ones. So the first one is, like, insurance companies don't pay out. What's the point of it? Because we're not going to get it at claim time. We've all heard about the disaster stories about, flood insurance in Queensland. Well, if you live in a certain area, they don't pay out. And you only find that out after you've had you need to claim on it. Or, in Victoria, we've got plenty of fires here in Victoria. And if you're in a fire-prone area and you've got a house and it burns down, well, the insurance company doesn't pay. So people have a really kind of negative view towards insurance companies. They're there just to make money, and that's all they care about. The thing about life insurance, the style of insurance that we're talking about, life insurance, disability, trauma, income protection, is they do pay out claims, and they pay out a ridiculous amount of claims. So this is all data just from the Money Smart website. The Money Smart website's set up by the government, and it's just a whole bunch of money information. So if you haven't checked it out, it's a really good website to check out. A part of their website is they've got claim statistics for different insurance policies, and they update it on a regular basis. So these stats are based off between the 1st of July 21 to the 30th of June 2022. So they're really recent stats. It's not like 5 years old or 10 years old. And this is for all policies that are set up for a financial advisor. You can see that 97% of all life insurance or death insurance claims are paid out by insurance companies. Income protection, it's the claims acceptance rate is 95.3%. Trauma insurance, 83.6%. Oh, sorry, I said the wrong number. 86.6%. And then TPD, so total disability, is 84.4%. So the thing about those claims is that it's such a high percentage. Now, if you're skeptical like me, and you're anything like me, I would look at it and go the opposite and go, well, okay, if income protection, just almost 5% aren't paid out, why is that the case? Welcome all those skeptics like me. And for income protection, there's a lot of data because it's the most claimed on. And majority of the claims for income protection are just for events that are not claimable. So you submit a claim, you're off work for 60 days, but your income protection policy has a 90-day waiting period where you're not eligible for a claim, even if you've submitted that claim. So that'll get declined. Some declines are because it's not covered under the policy. So again, trauma, you go and claim for something that's not covered under the policy. Like I, tore an ACL, so I submit a trauma claim. It's not under the trauma policy, so they'll decline it. So it'll mark against their decline stats. And life and death, there are some things like terminal illness that some policies will accept the claim and some won't. Now, you're dead. You should be 100% of all claims are paid out. But there are some instances where there's terminal illness, but it's the diagnosis says that you'll live longer than 12 months, so they won't pay out a claim. So there are some declines in there, and disability is the hardest to claim on. It's the hardest to prove because you've got to be totally and permanently disabled. So that's why that number is the lowest out of the four. That myth that insurance companies don't pay out claims is just factually not true. The other myth is it's cheaper to go through your super fund. Now, the barefoot investor says this all the time. Just go through your super fund, get your insurance in place, and happy days. And it's interesting. Now, this is stats. Now, this is data. We, do quote comparisons all the time in our business at Skye. So now we look at like the default cover with Australian Super. Now, Australian Super are not an insurance company. The insurance company that Australian Super contract out to is called TAL. And so if you go through Australian Super, the default level of cover that you get just automatically, it costs you $113 for a 35-year-old radio technician on $85,000 a year. And the level of cover is, $2,900 per month. It lasts for 2 years and kicks in for 60 days. So if you go to a financial advisor and get that exact same TAL kind of terms with a TAL policy, it will be more expensive than going direct. So yes, the default level sometimes is cheaper. But then if you go and say, hey, actually, I'm on $85,000 of income. I want $5,000 per month of income protection. I want a 30-day waiting period, and I want to get paid till age 65. If you go to Australian Super, remember that the insurance company's TAL, you're going to get charged $2,067 per year. So that's annual premiums. When if you go through a financial advisor and set up a TAL policy, so the same underlying insurance company is now costing you $776.52 because we like to be accurate. I don't know why I did the cents, but I did. And so you can see the increase on that premium is heaps. You got almost 2,000% increase on the premiums, changing those policies within Australian Super. But with TAL, you're increasing by less than 300%. So yes, that default cover is cheaper in this scenario, but if you want longer cover or higher levels of cover, that super fund wasn't cheaper. Now that's not all the time, and I'm not like that's not cherry picking data. That's what we see. Probably 80 to 90% of the time. It's always not always 80 to 90% of the time cheaper to get the high level of cover through the same insurer externally. And then the next example is CBUS, which also use TAL. So CBUS is another massive super fund in Australia. They contract out their insurance to TAL as well. So the default level of cover for life and TBD for a 26-year-old carpenter, and the default level of cover is 208,000 of life insurance and 156,000 of TPD. And the premiums for that is $602, let's just call it. But if you go to TAL through an advisor to get the same level of cover, you're getting charged $305. But then if you go and say, look, I want $1 million, I'm just about to have a kid, I got debt, I want $1 million worth of cover, then the $1 million of life and TBD through CBUS is $3,830, not $3.83, because that should be a comma, and it's not. But it's $3,830 per year in premiums. When again you go to TAL, which is again the same underlying insurer, it's going to cost you $987 per year for that same level of cover for the same person, same occupation. And you can see the increase as well is, even though it's higher, it's a smaller level of increase on a percentage basis. So a lot of people think, oh, let's just go through the super fund. It's cheaper, it's easier, it's better. And it's, in fact, if you're getting a reasonable level of cover, it's often not the cheapest. The third myth, insurance is just too expensive, way too expensive. Why would we get it? The reality is that, for a young family, I just did a quote, we've got, don't know if I wrote the exact ages, but 32-year-old and a 31-year-old. So one's working, one's not working. So the pretty much the atypical, family household with young family, one person working, one person, caring for kids. So the level of cover is life and TBD for $1.2 million, trauma of $150,000, and the working partner is getting income protection. Now, for superannuation, this is the great thing when you're setting up policies through a financial advisor, is that you can get your super fund to fund a lot of the costs of the cover, which for young families is extremely important to be able to have that flexibility. We don't, all have spare cash coming out of our ears. I can definitely tell you, as a father of 3 young daughters, cash flow can be tight. So using superannuation when the biggest need for cover is today, so using my super fund to fund a lot of that premiums for the short term or long term is really important. So for the working partner with that cover, it's costing $1,370 per annum through super. So the super fund pays for that, and $16 per month from your bank account. And so a total of, $2,155. And for the non-working partner, so there is no income protection there, so that the cost is much lower because there's no income protection, $587 per annum, and then $18 per month for the cash flow premiums, so $785. So as a household, you can potentially spend less than, $3,000 a year to set up, fairly decent levels of cover. Now, one thing to note, that is stepped premiums. Now, we're not going to touch, I'm not going to touch on, I don't think Azaria is, we're not going to touch on stepped or level premiums and how that works, but I have the exact same examples on level premiums, which basically means you can pay a lot more today, and it can be affordable in the long term. So when you're in your 50s and 60s, the cost doesn't increase significantly, but you got to pay more today. So there is a big, discussion about whether that's worthwhile. We like to use that at Skye. We do like level premiums. I personally have my cover on level premiums, but you can see the exact same example on that higher level of cover. But you can see, as a family, to get really good, levels of cover on level premiums, which is more sustainable in the long term, it's costing us, $110 from our bank account. Now, a lot more from super, but, we pay heaps more than on that, just on, Happy Meals with the girls at McDonald's. So a lot of people think it's really unaffordable, but when you break it down and compare it up to the other lifestyle costs, and consider you can pay a lot through super, it can be quite reasonable. Myth number 4, it's not worth it if I get an exclusion. So the thing with insurance policies is when you go and apply for the cover, you can get an exclusion on the policy. So that just means that if I go to claim on a certain aspect of my health, they won't pay out. So, and that will be determined when we apply for it. So if I've had a history of sore backs, and I go and apply for cover, they may exclude my back because, even though I'm desk bound as an advisor, we still sit all day. So we need to be able to work sitting down at a desk. So they may exclude my back. Now, a lot of people think, well, that's actually just not worth anything if I'm getting that exclusion. And we totally appreciate why people think that, because that's the most kind of pressing thing. The thing that I say is that it's not just that one thing that is going to be claimed on. There's a whole range of things that will be claimed on. So, these stats are for one insurance company. So Tower, they've just got really good access to their data pool from 1st of April 2008 to all the way to 31st of October 2020. They've got their stats on their claims history. And so over that period of time, for male and females under the age of 55, 28.55% of those claims are for accidents and injuries. Now, accidents and injuries are rarely related to any exclusion. And so insurance companies won't put an exclusion on your back, they won't put an exclusion for accidents. And if I get in a car accident and break my back and it's not related to my previous back issue or concern, and the claim is not made worse because of that previous back issue, then I can still get paid out a claim for breaking my back in a car accident, even if I do have a back exclusion. 19% is for bones, joints, tissues, 19% is for mental health, 11% for cancer. So there are so many things that are included in the policies overall for all policies that even if I even if I get a back exclusion, it still makes the rest of the policy worthwhile. So there's a whole bunch of kind of data around claims. Here's a few other things there, but yeah, we often just talk about, like, even if you have an exclusion for any reason you're off work outside of that one thing, there's income protection. I'm not going to die because of my back, so it doesn't mean I should still have life insurance. So we talk a lot about making sure you're still covering yourself even with that exclusion. So next up, we're going to talk about case studies.
Yes, so very good lead on from what Phil was just talking about. There's a number of things that people claim on their insurances for. And what we're going to go through now is just 3 cases that we've had in the last couple of years, all for different reasons and all people with different situations. So having a look at the first claim here, this is one that we've had recently. So we've had a pancreatic cancer claim. This is for a male aged 43, very healthy guy, married, 2 young boys, and a $500,000 mortgage. So out of nowhere, he was diagnosed with pancreatic cancer. Huge shock to us, huge shock to his family, of course. In his case, he immediately needed chemotherapy. So straight away went under treatment. He needed, of course, time off work to undergo that treatment and go through the recovery that comes with such a intense treatment. And also his wife needed to take some time out of work as well, because the last thing you're thinking of doing when your husband's been diagnosed with cancer and your family's undergoing such stress is going to work. So she needed to take some time off work as well to provide support to him and to their children. So in his case, what did we get? So number 1, his income protection kicks in. That income protection is covering roughly 70% of his income each month, and that's an ongoing claim. So after that waiting period finished, he started to receive that income, and he will continue to do so until he can either go back to work full-time or part-time, in which that might kick into a partial income protection claim. So he's got that one there that's covering their ongoing expenses. And the second thing he got was a trauma payout. So he had $191,000 worth of trauma cover, and trauma cover that can pay out after 2 weeks of the initial diagnosis. So he got paid that $191,000. So what we're hoping in his case is that he makes a quick recovery, he's able to get back to work and doesn't need all of that money. If that's the case, then it could be that they potentially take a family holiday, they pay some money off their mortgage. But if it is going to go there for longer, then they've got that income protection ongoing covering their expenses, and they've also got that lump sum of money through their trauma payout as well. So that's just one really recent example of someone who has been hit with an unexpected illness, the last person you'd expect, but they've at least the last thing that they want to worry about is money, so they don't need to do that with the income protection and the trauma paying out. The second one we've got, this one's a little bit different. This is a multiple sclerosis claim. So this was a woman aged 29, so very young. She was married, no kids at this stage, but she did have a $400,000 mortgage. So she was diagnosed with multiple sclerosis. She needed to, of course, take time out of work to undergo treatment and attend doctor's appointments and figure out what was happening in her situation and kind of get an idea of what she could expect moving forward into the future. So in her case, she received her income protection. Initially, that was a full income protection claim. So for around, again, 70% of her income was paid out. And then eventually, as she got a bit more of a hold on the condition and understanding of what was going on, she was able to return to work part-time. And then that income protection at that point switched to a partial claim. And then eventually she was able to make a full return to work. So on top of that income protection, she also got paid out her trauma. Multiple sclerosis does come under one of the 40 different trauma conditions, and she got paid out $165,000 for that. So she was able to use that for medical expenses, again, time out of work, and any number of things that she could need that money for during that time. So that one is multiple sclerosis. And then the next one we've got is a breast cancer claim. So as you're going to see, cancer is one of the most common reasons for claims on insurances. This was a female aged 34. Now for her, she needed to, of course, take some intermittent time off work to undergo treatment, attend doctor's appointments. And throughout this time, thankfully, she was still able to work part-time. So she received a partial income protection claim until she was able to go back to work full-time. Luckily, in her case, it wasn't too severe and it was able to be treated quite quickly. And her trauma also paid out. So $129,000 worth of trauma was paid out into her bank account. Now, a good thing to remember with trauma, the rules of a payment is if you meet the condition of a trauma claim, then you get paid that amount. They're not assessing how long you need to take off work, how serious the illness is, how traumatized you are, as the name trauma might imply. As long as you meet the condition, then you get paid that amount. So in this lady's case, although the breast cancer treatment, etc., didn't need to go on for too long, she still got paid out her full amount of trauma for $129,000. So that's just 3 examples of a number of different things people can claim on. So you've got cancer, heart attack, stroke. It can, again, be things like multiple sclerosis. It could be loss of eyesight. It could be that you're in an extended coma. There's a huge variety of things. We've also had a claim recently for long COVID. So you might be wondering if COVID-related claims are an option. They certainly are. We've had someone who had long COVID and had ongoing chronic fatigue and was able to claim as a result of that. We've also had broken legs, and a number of different things. Now, our clients are quite young, which is why you're going to see that a lot of these clients are really young. We're not trying to spook you. These are real cases. Thankfully, we don't get a lot of claims because our clients are mostly very young, very healthy. But as you can see, these things can happen.
Here's what I found.
Oh, sorry, my watch is going off.
Sorry, shut up.
To say. But yeah, these things can happen at any time to anyone. So we just want to make sure that you've got this cover young or as soon as you can, so that if anything did happen, then you've got that cover there. So just a few examples of some of the cases that we've had. Phil, would you like me to talk about this one?
Yeah, let's go. Yeah.
Yeah, great. So I mentioned this at the very start. You might not have heard, but we have been wearing our watches, and that's why they're talking to us religiously this week, because we are raising money for pancreatic cancer. So you would have seen in that first case study, we have had someone claim for pancreatic cancer, and that's someone who's not only a client, but quite close to us in our business. So we, in the past, have had step challenges at work just to get people off their butts, walking around, being healthier. We all work at a desk all day, so it can be easy to forget to make time for our physical health. But what we're doing this time around is we are doing this for charity. So we're raising money for PanCare. So over the next 6 weeks, every staff member at Skye is getting their steps up as much as they possibly can. We're donating 10 cents for every 1,000 steps that our team makes. And we're also opening the donations up to the public. So if you'd like to make a donation, we've got the link there. We are wanting to raise money for pancreatic cancer while also promoting, of course, better health and doing everything you can there. So if you'd like to donate, please do. We would love that. We're going to make regular updates on our social media, so make sure to follow us on Facebook and Instagram as well. We'll keep you updated on our progress there.
Yeah, we're excited. I hit up a whole bunch of insurance companies today and just guilted them into helping us raise money as well. So one of our connections at an insurance company, donated $100 straight away. So that was very generous of him. But yes, guys, we're donating money. So I think, I don't know, I worked it out. It's going to be like, $20 a day or something by the rate in which we walked yesterday. So yesterday was our first day. Today's our second, which we've got to go out and get cracking on it as well. All right, so we've got a link to donate. There you go. Well, I got to remind me. I got to make sure Skye donates every week. I'll make sure we keep donating. We drip feed it so we can actually show people we're going to put the money in.
Yes.
All right, next we're going to talk about determining the right cover for your family needs. So it's really interesting. A lot of people, we want to DIY a lot of these things, personal finance. There's so much amazing information out there to DIY. And the purpose of this is not so people can go away and, the purpose of this webinar is not so you come and say, Phil told me to do this and I went and did it. Because as I said at the very beginning, this is all general information. Please don't come back and tell me that I told you to do something, because that is certainly not the case. But we want to be as helpful as possible. And so there are kind of some things that I just want to touch on when it comes to, determining the right cover. Now, I'm going to talk about like what we do at Skye, like how we work and how we think about it. But it is, if you do want to DIY, it is definitely think about it in the exact same way. So the first thing I always think about, insurance, this type of insurance is all based on your health history. So your health history is the number one thing. And so everyone's unique. Everyone is different. I could be sitting next to another 36. How old am I? 36. I think I'm 36. 36-year-old male financial advisor, same height, same weight, but our health history could be completely different. I may have gone to, had a sore back, and they could have gone to a doctor's appointment, 2 years ago that will have an impact on their insurance application. And one thing that really just clearly illustrates this is a family history of breast cancer. So, and all cancers, very similar, but breast cancer is kind of the easiest one to show a big discrepancy between insurers. So I'm kind of just showing you this example with family history of breast cancer. So the person applying has not had any kind of diagnosis or any symptoms of, lumps or anything like that. It's just their mum was diagnosed at age 45, made a full recovery, and now the applicant or their client is applying at age 33. Now, each insurer will have a very different stance on this particular issue. And that is the same for every health issue. So one client can have 10 health issues that insurers will have different stance on. Another client may just have this and that's it. So in this scenario, insurance company A will say, hey, we're going to exclude breast cancer from your trauma insurance policy, income protection, and disability. So if you have breast cancer for any reason, even if you've done a test and you don't have the BRCA gene, doesn't matter, we're still going to exclude it. And so it's going to be excluded on all trauma, income protection, and TPD. Now, they won't do it on life insurance, generally not. And then insurance company B will say they will exclude the policy, exclude it from trauma only, or provide a 50% loading on trauma. So you, as the applicant, you can decide which one you prefer. Actually, I prefer exclusion because I don't want to save a bit of money, or I have had experience in that in the family and I know how impactful it is and how good it would be to have that trauma policy. I'll pay a little bit more, so that 50% loading on the policy. While insurance company C has a differing view on family history of breast cancer. As long as your mum was age over 40, we're not going to put any exclusions or loadings on the policy. So just that one example can show how vastly different insurance companies are in this space. And this is an actual example of how insurance companies. I can name all three insurers. I'm not allowed to. I won't. But it really does show you the differences between insurers and the outcome of an insurance application. And we do this all day, every day, so we kind of geek out about it. We just track all of this information internally and go, okay, for breast cancer, family history, we're not going to go with A, B, and C. Wouldn't much rather, well, A and B. We'd much rather C, even if they're more expensive, because that's important to our clients. But if you DIY, go and talk to the insurance companies about your health history and the impacts on an application. So the next thing is like level of cover. Azaria touched on this before, so I'm just going to do a high level, but thinking about the level of cover is really important. Did I touch on him before? But Scott Pape talks about like cover for life insurance is like 10 to 12 times your income, and that's a good benchmark, which makes a lot of sense for some people. Can miss the mark a lot with other people. So if you're a stay-at-home parent earning doing part-time work, $10,000 a year in part-time income, well, $100,000 or $120,000 of cover is nowhere near enough, and in my mind, nowhere near reasonable. My wife at the moment is not working, is writing a book, which is really exciting for her, but we're not going to do 10 times nothing for her life insurance, because I would be completely stuffed. If my wife went away for 2.5 weeks to Morocco last year and the house almost burnt down, I can tell you I would be gone without Kate in my life. And so the income that she's generating or not generating is not the most important thing, but I need money to help me look after these 3 beautiful young girls. And so we think about clearing debt as well, clearing your home loan and replacing some income. And if you don't have an income, replacing some money to cover the cost of that lost person. So in my case, we think about $60,000 for extra care for the girls per year for a certain number of years, plus funeral costs. Disability is similar. So clearing debt, replacing some income. Now, if you've got income protection as well, that can pay out at the same time as disability and medical expenses. And so as Ari talked about, like trauma insurance, we think about medical expenses and then replacing some of your partner's income or all of your partner's income for a period of time. And then income protection, I really like getting the maximum amount for the longest period possible. And then the thing that you can the lever you can pull and adjust with income protection is how long are you willing to wait before you get that income protection payment. So you can wait 30 days, you can wait 60 days or 90 days or even 2 years, which is really long. I wouldn't last without income for 2 years. But that can adjust the premiums. So thinking about the level of cover is really important. And then the next is the premium structures. So how do we actually pay for them? I kind of touched earlier about the examples of different options and premiums. But the different options is your superannuation can pay for all of it and own all of it. Now, one thing to note with trauma insurance, you cannot have that policy if you only have insurance through your super fund. So that has to be paid personally. And so, if we were to structure all 4 of those policies, we would actually use a split ownership. So most of the super fund can fund the policies, and then some of the premiums will come from your bank account. If you go through your super fund, you're only ever going to have the superannuation owned policy. If you go direct to, just purchase it direct off TV, it's always going to be owned personally. So your life insurance, TBD, income protection, and trauma has to be owned personally. But split ownership is often set up through financial advisors, and your advisor will kind of talk about the pros and cons of how to do that. And then the last thing is like, which insurance company is the best, Phil? Like, just tell me the company that makes the most sense. What's the cheapest? What's the best? It is all based on each individual special butterfly. And that's why at Skye, the majority of our time and the majority of our effort is on this underwriting, which is just a fancy way of saying that the insurance company will assess you and your health and who you are from a health point of view, and determine how they're going to insure you. So that actually drives more than 50% of our recommendations. So which insurance company we tell people to go to is driven majority by underwriting, and then next it's about the price. So at the end of the day, insurance companies, like, if there are any insurance companies listening, they're all the same. Like, they all do very similar things. There's not real huge discrepancies in claims acceptance rates or in terms and policies. There are some, but overall, it's just about the type of policy, the structure of the policy, making sure that the level of cover is really good, making sure that they're going to insure you for the most that they can. And then whichever name insurance company it is actually doesn't matter as much as all the rest of that. So I hope that helps. I know it's basically like, you didn't tell me the insurance company to go to, Phil. That's pretty useless. Well, sorry.
Perfect. Alrighty. Well, that about wraps up the things that we're going to be touching on today. I will just say, why should you take out life insurance? If you've watched this whole presentation and you're still not convinced, a couple of things I'll mention. Number one, protecting both yourself and your family in the event of illness, injury, or death. Just making sure that you're not leaving behind an absolute catastrophe if anything were to happen to you, and that you can still maintain a similar level of lifestyle if anything were to happen. Secondly, taking out insurances early can result in more cost-effective premiums over time. So you might be young and think, well, I'm probably not going to need an insurance claim. I'll just take it out 10, 20 years down the line. It's usually the younger you get it, the cheaper it is as well. And the last thing is, the healthier you are, the easier it is to take out cover. So the difference between now and 5 years could be massive. Sometimes we'll get people coming through wanting to get advice after reaching out a few years ago, didn't decide to go ahead with it, and now they've had a whole heap of medical issues that's going to make it a lot more difficult to get their insurances in place. So reach out to any advisor or get your insurances sorted out as soon as you can, while you're young, while you're healthy, and while you've got things there to protect. So just a bit of a summary of why we personally believe in life insurances, why we all take them out, and why we think you should too. Definitely something to prioritize.
And just touching on that as well, I'll go back to that, like, protect yourself and your family from the financial impact of illness, injury, and death. Like, that case study, the first case study, is a really, really close friend of mine, and helped him through the claim, and it was difficult time for his family. But I remember just saying to him, like at the end of the day, we're not going to change the diagnosis. You got pancreatic cancer, like nothing I can do. But at least the insurance, the money that hit your bank account for that insurance policy, so income protection and trauma, is going to take that financial burden away. And to go even further in his experience, like it's basically like a changing his life. Like he's his third round of chemo today, and I'll call him up tomorrow. I've called him up the day after his chemo treatment every single round, and I'll call him up tomorrow just to kind of check in, see how he's going. But like, it really does afford him just the release of stress of knowing that, hey, guess what? My income that I was earning to support our whole family is lost now for a period of time, and yeah, we're not going to change his diagnosis. He's still got to go through cancer. He's still got to beat, his cancer, and got to go through that battle. But having the money in the bank just has a huge, release of stress from his life that is so important. And, people hate premiums. I hate premiums. I hope to never claim on my premiums. I whinge about, I'm such a tight ass. I whinge about having to pay up public school fees. It's like $300 a year, and I get grumpy saying to my wife, it's public school, why are we paying for this? Like, the government should pay for this. So I am such a tight ass when it comes to everything in life, but insurance is one of those things that, in my mind, I can kind of never get enough. Like, I'm actually thinking about increasing it because even though we're getting further on in life than when we first set it up, we've got more debt. It will have such a much bigger impact if something happened to me or Kate. And as I said, just because Kate's not working doesn't mean it's not going to have a massive financial impact. Anyway, rant over from me. Let's go into our Q&A. Did you have anything to touch on before we answer some of these questions?
No, I think we've got some really good questions there that we can dive into.
Cool. If you got any questions, just write them down. Don't know how to do it from your end, but write them down.
Perfect. All right. We've got one question from Daniel. He asked a really good question. I think we might have answered some of this throughout the presentation, but what Daniel asked is, how difficult is it to get insurance with pre-existing medical conditions? Do you just pay higher premiums, or are you excluded entirely from some insurance companies? So as you would have seen in these examples, there are a few different things that can happen when you have a pre-existing condition. Number one, that pre-existing condition might just be excluded, which means you'd be covered for everything except for that one certain thing. Number two, you may still be covered for that issue, but you might be stuck with a loading, which means you pay a slightly higher premium, but you are still covered for that pre-existing condition. Or number three, you might be declined certain covers entirely. So it's not as common that you'd be declined life, TBD, trauma, and income protection all at once. Sometimes it might be a case that trauma might be declined, or income protection and TPD might be declined. But what we do at Skye, and what we have the privilege of being able to do as advisors, is pre-assessing. So when we get your information through initially, we ask questions about your health, your financial situation, your work, and we have a chat to insurers and say, hey, we've got someone with these pre-existing medical conditions. These are the insurances that they're looking at. How would you assess their application? And as you would have seen from Phil's example, it can vary massively. So that's why we do that for every single client that we have, just to make sure that we're not going ahead and applying for a company that would just decline your cover entirely. So we've always got a pretty good idea of what the outcome's going to be before we even get started, and we can talk to you about that and talk about your options there as well. So it really depends from person to person what the situation is, but be rest assured that we kind of look into all of that before any applications are actually lodged for you.
All right, next question. Is there any, sorry, Laura, thanks for asking the question. Is there any impact of being self-employed on any of the insurance types? So there is. The lump sum covers, so life insurance or death insurance, total permanent disability and trauma insurance, generally speaking, whatever you pay for, you get paid out on at claim time. It's got not too much to do with working, with kind of little exception of disability. Depends on what you do and how you work. But income protection is the one that's the biggest impact. So a lot of people who are self-employed, they work really hard with their accountant to minimize their tax through income splitting, or, however they do it, they try and minimize their tax, and that can impact an income protection application and an income protection claim. So it's really important to just make sure, whether I don't know if you've got cover in at the moment, Laura, but let's just assume you've got cover in place. At claim time, your contract will determine what your pre-disability income is. And that can either be the last 12 months or the best 12 months over the last 3 years, depending on the policy you've got at the moment. And that will impact it. So if you've been minimizing your tax for quite a number of years leading up until that claim, that could impact how much money the insurance company is going to give you. And it does impact it when you apply for the cover as well. So whatever your kind of last few years of your tax return says that you're earning will be included. Now, it's a very nuanced question. So there are a few other kind of factors involved. So if you are income splitting purely just for tax purposes, then sometimes you can add back the non-working spouse's income on your income protection payments. Things like depreciation that is kind of just like fake money. Really, depreciation is not real for some things. You can add back depreciation for some things on top of your income. And if you are part owners in a business and there's $100,000 of profits and you part own, $50,000, then that can sometimes be added. So it is a bit more complex when it comes to income protection. The other covers are fairly straightforward. If you've got $1 million of life insurance and you die, they'll pay out the $1 million.
Perfect. Got another question from Daniel. He said, do these life insurance companies pay financial advisors different commission rates for getting clients to sign, or are they all the same? So the answer to that is it's the same no matter which insurance company we recommend. The commission we receive is based on a percentage of the premium, and that's a flat percentage no matter who we go with. So we're not incentivized to recommend one insurance company over the other. As you would have seen throughout this presentation, number one, it's based on your health history, and then it's often based on price as well. So same regardless of which insurance company we're recommending.
Cool. Hegs. Thank you for giving us a a heads up on how to pronounce your name, because I would have butchered it like nothing else. What happens to your insurance when you are on maternity leave and then you decide to return to work part-time? Again, a really good question, assuming you've got it in place. Again, that income protection, there is a lot of nuances with income protection. So the other covers are generally fine. Whatever you're paying for, if you make a claim on those covers, you get paid out. Income protection is the trickiest one. So if you've set it up recently in the last, since the 1st of October 2021, it'll be based on your last 12 months of income. So if your income is, let's just call it $80,000, and then you go on maternity leave for 6 months and then part-time, at 12-month mark, after maternity leave, if you go on claim, they'll only look at the last 12 months of income. Now, if it's an older policy, they can look back at your best 12 months of income over the last 3 years. So income protection has changed. A few years ago, the insurance regulators came down pretty heavy on income protection and trying to make it more sustainable, which sustainability is really good, and it means premiums are should be much more stable, but it does mean that a watering down of some of those features. So it is really important to keep in touch with your advisor and just keep them informed. Hey, I'm going on mat leave. What's the impact? Because we have it all the time. Clients basically reach out all the time and say, hey, this is my situation. Do I need to do anything? Sometimes the answer is really simple. Don't stress. You don't need to change anything. Sometimes it's just a matter, okay, here's the pros and cons of the different options. What would you prefer to do? Because sometimes you can, have some premium pause features within policies. But it's also a matter of thinking, well, if you dial down the level of cover and then you have a health event, you may be stuck at that lower level. So there are pros and cons to kind of that answer. Hope that's kind of answered your question.
Awesome. We've got another question here from Emily. She said, if you die of old age and your insurance is still paid out to your estate, right? How is it possible for insurance companies to ensure something that 100% will happen? So that's right, we 100% will all die. What you'd probably find is, though, that by the age that we pass away, if that's of old age, by then we probably don't have our life insurance anymore. So let's say you're 67, you're fully retired, you've got a good super balance, you've got enough income to see you through. And by this point, your insurance premiums might have become quite expensive. You'll probably find at that stage, you'd have a look and say, is the value of having this insurance comparable to the premium that I'm currently paying? And what you'll often find is that by that point, a lot of people would have cancelled their insurances at that stage. And I do believe that most life insurance policies do have an expiry age as well. So it wouldn't cover you until you're 130 years old, for example. If you
most expiry age is like 100 years old.
Yeah.
But yeah, the reason it's profitable is because like the way insurers price it. My nan, 99, about to turn 100. I hope she does. Hope she doesn't die beforehand. Not just because she doesn't die, but I wanted to get a letter from the king. But so if she still had insurance and she had $100,000 policy that would pay out $100,000 if she passed away, the cost at this age would literally be $90,000. So it just wouldn't make sense for her to keep it anymore. And so that's why it makes sense, because the costs really skyrockets it gets expensive kind of in your 60s, but then, if we're talking 80s, 90s, it's just obscene and doesn't really make that much sense to keep it. So that's how they make money. That's how insurance companies make money. It's all based on how likely are you to have this event, and therefore how much is that costing us. Emily, you had another question. For what life events would you look to increase or decrease your level of cover? How does insurance grow with you? Great question. So there's two things. So insurance, your level of cover can increase with inflation over time. So every 12 months, generally it's called indexation. So you've got $100,000 of cover today. Inflation, I won't go too deep into this, but inflation is, let's call it 5% inflation. Your level of cover will go up by $5,000 for the next year. So last year it was $100,000. Now it's $105,000. So every year it'll just automatically increase. And so there's So that's kind of how it grows. But under certain life events, like getting a mortgage, if you go and get a $500,000 mortgage, well, if you passed away today, can your partner service that? Maybe not. So you need more cover. So you need to go back and apply for cover again. Under most circumstances, you've got to go through an application process with the insurer again, because they want to know, okay, we're on the hook for that $100,000, but now you want an extra $500,000. Well, we want to know, has anything happened in your health, that makes us less likely to offer you that $500,000 of cover. So yeah, you can adjust, increase and decrease over time. So again, if you get an inheritance, you pay off that loan. Okay, maybe we don't need as much money we don't need as much insurance. We can just reduce that cover.
Perfect. Natalia has a great question as well. She said, are there waiting periods? So with income protection cover, they all come with a waiting period. So you can generally choose that. You can often have the options of 30 days, 60 days, 90 days, sometimes 6 months, sometimes 2 years. So that's the length of time that you'd need to be relying on things like sick leave, annual leave, and savings to see you through that waiting period before income protection kicks in. Now, in the other insurances, there's not necessarily a waiting period, so to say, but there are a couple of things to consider. So for life insurance, generally within the first 13 months, they wouldn't pay out for suicide. And then for trauma insurance, there are certain specified conditions that have a 3-month qualifying period. And what that means is if symptoms of your condition arise within the first 3 months of taking out that trauma insurance, or if you go to a doctor and identify an issue within the first 3 months of taking out that trauma insurance, they may not pay out a claim in that first 3 months time frame. And the reason they do that is because what they want to avoid is someone potentially feeling a lump on their breast, thinking, oh, that doesn't feel good, I'm going to go get some trauma insurance. And then as soon as that trauma insurance gets put into place, going to the doctor, they identify that as breast cancer and then claiming straight away. So they just kind of do that to make sure that people aren't kind of rotting the system in a way. So usually 3 months for certain conditions on trauma insurance, but that's generally how the waiting periods work for those policies.
Yeah, so that client who had breast cancer had that similar experience. She went to claim 4 months after the policy was in place, and the insurance company, when I was managing the claim, was just asked a few more questions. They were really good about it. They were just like, I just want to understand this. Literally found out breast cancer 4 months, and it was pretty simple resolution. I just went back and looked through our files and said, look, the client got introduced to us in July, spent 3 months before making a decision to actually go ahead. It took us a while. She in no point hurried the process, and it took a while to get it all in place. So there was actually 6 months between first contact and getting the policy in place. So there was no rush or hurry. And so that, it was basically the claims manager just wanted to double check, hey, is there any kind of, anything untoward here? And it was really simple to resolve it. But it was interesting because it was just after that waiting period. And also on top of that, they actually backdated the start date of the policy as well. At the very beginning, we asked them to backdate it. And then so the policy actually should have been enforced like within that 3 months, but they backdated it. Anyway, really, really good outcome for all, but except for the insurance company. All right, next question. What do we got? From Laura. I recall seeing something about child critical illness cover. Is that included in one of these insurances or something different? That's a really good question. Probably not good of us not to include it, because we include it for all of our clients with kids above 2 years old. So it's definitely a cover we recommend and strongly believe in, and I've got it for my 3 kids. And so what it is if your child has a critical illness, so it's kind of like a mini baby trauma, so a mini trauma policy for your babies above 2 years old. And under serious illnesses. So there's like 8 conditions and upon death as well for some policies. So we don't talk about it too much. We strongly recommend it for every one of our clients. But it's not, talking about death is one thing, about yourself dying, making sure you're protecting your family. Talking about your little ones dying is a bit more kind of difficult and probably not as exciting or fun to talk about in a webinar. But it is definitely something we look at for our clients and we recommend you have it, and I have it. But for most of the time, your child needs to be above 2 years old and under 18 years old. And once they get to 18, they can just have their own policies. Right. I hope that answers your question, Laura. I think, if there's any more questions, we're going to start to wrap this up. If you do have any questions, feel free to reach out to us. Now, we're here to flog insurance and sell you to get insurance. Whether you come to us at Skye, we're financial advisors, whether you get it through us, to be perfectly honest, couldn't care less. Much more important that people get insurance. And it sounds like I'm being a bit funny. I'm being legitimate. And I say this all the time to people. I am everyone at Skye is so much more passionate about people getting insurance, because as we touched on at the very beginning, 29% of young families have life insurance in place, and that's ridiculous. So if you need help with insurance, or even if you've just got any questions following this webinar, just reach out. Just click on that link, goes to our website, books in a call with one of the advisors. I hope this webinar has been really helpful. We will there's a recording of this at the end of it. So if you want to rewatch it, you can do that. And we do have another question from Laura. Is there an hourly rate for you as advisors or commission from insurance providers? Good question. I wasn't going to give a pitch, but I'll give you a pitch of what we do. So what we do is we start off with a 15-minute phone call. So if you book it in with one of the advisors in the team, then we just have a chat about, answer any questions you've got. We have a chat about our process. But basically what we do is we start off with an insurance proposal. So we gather all that information, gather all your financial information, your medical information, your health. So when I say medical information, I don't mean like we go to your doctor and get a report. I mean, you just disclose everything that's relevant. So we get you to ask, we ask you a whole bunch of questions about your health history. And from there, we take that information and we take that to insurance companies. And we don't have your name or your date of birth or anything that identifies you. We take that to insurance companies and we say, hey, how would you assess this? So going back to that exclusion or the family history of breast cancer example. So every situation regarding someone's health is impacted. So we ask insurance companies, hey, how would you assess this? They all come back to us and say, we'll give you an exclusion or we'll put a loading on it or whatever the case may be. And then we come together with an insurance proposal that says we recommend this insurance company and these are the terms that we expect. So an exclusion or a loading or no terms at all. And this is the level of cover we recommend that you take out based on your financial position. And for that, level of work and detail, and we do an hour meeting with the advisor, we charge a fee for that. So we charge $330 for individuals and $495 for couples for that insurance proposal. And then if you choose not to go ahead with anything we recommend, happy days, you've got your insurance proposal. And then if you do choose to go ahead and we help you implement the insurance and apply for it all, we get paid a commission from the insurance company. So as I think Daniel asked it before about the commissions, it's standardized. It's all been legislated how much we get paid. And it's all disclosed in the proposal as well. So we tell you, hey, this is how much we get paid to help you with it. So that's kind of our process. But there's 15,000 advisors in the country. So just whether you go through us or go through one of the other 15,000, just get your insurance in place. Now we are giving away books. I think I did see Glenn James. He was like messaging me through this whole thing, just harassing me. So we are giving away books. So for the first 25 people that signed up, someone in my team will reach out. If you reply back to us and it goes into our junk folder and we don't reply back to you, it means it went into our junk folder, which happened last webinar. So we'll reach out to the people who are going to get the books and I'll send them out and write you a message. I probably won't write you a message. I'll just say congratulations. And then we'd love feedback as well. So once this webinar is done, you'll automatically be redirected to a survey after this webinar. Don't know if you left early, if you got sent there or not. Don't know how any of this stuff works because I don't set it up. I know about money and insurance and finance. I don't know about webinars. Anything you want to finish with, Azaria?
No, just wanted to say thank you guys for all the really great questions and the feedback. It's been really, really helpful. And yeah, if you do have any more questions, we're happy to address those in the 15-minute phone call, and send us through an email as well if there's anything that we can help out with. We're just really glad to see so many people turn up and take an interest in their financial security for their families. So something we're really passionate about and something that we think everyone should be passionate about. So thank you all for coming.
Awesome. And the ironic thing about doing a webinar for young families is doing it at 7 o'clock. My daughters go to bed at 7:30, so this would have been the worst time. So anyone who did turn up, well done. Awesome. Thanks, everyone.
Thank you. Bye.
Don't know how to finish this. What am I doing?